Hello and welcome back to Nearsight and Farsight. I'm your host, Kevin Taylor. Today we're going to talk about a couple of different things that have happened over the last quarter and give you a couple of our thoughts on the quarters and the year to come. As we kind of wind down the year, we want to be able to illustrate some of our successes and a couple of the different positions that we've taken on and the ideas that we have going into next year. First and foremost, I think it's important to demonstrate that we are sticking to our valuations. When we see a market give more than we think it's worth, we need to be willing to take investments off the table and take profits for our investors. This has happened twice in the last quarter with great effect, and we want to be able to demonstrate some of those. So the first wave that we had seen in September, we raised cash routinely when the markets got a little too hot too fast. We also think that we're in the second wave of these excessive valuations again, and we're moving some positions to cash. So as you can see on this chart, this resulted in a very timely and prudent move where we were able to buy back in after some of the political jockeying had subsided for less. So each one of these white down ticks is representative of us raising cash in the portfolio and limiting our exposure. And then when you see the green ticks come back in, that's us saying, hey, conditions are good. We've gotten the all clear. We do think the market's going to move higher. So as we continue to manage this, we think that these are the right ways to position ourselves and profit from some of that price action when we see things get a little too frothy. We think over the short term that cash raising is the kind of risk management that we want to be involved in. And in a market where there are not a lot of great risk alternatives, frankly, most of them are incredibly ugly. They're either highly correlated to the market or like bonds. They simply just aren't paying enough that we want to be out of the market for short, very frequent lived bouts of volatility. And so we think that cash is the best risk management alternative for us in the present landscape. On the whole, I think we're going to get more defensive going into 2022. We've seen some healthy profit taking in the last couple of weeks in the market. We want to look into more value names. The recent downturn has increased the volatility, and that those swings are going to be larger and larger to the downside than they are to the up. And we think that represents what we might see a lot of in 2022. We think that the market being able to produce double-digit capital returns on a fourth year is probably going to be harder and harder. And we think that there might be times where we breach that double-digit mark in 2022. We think that we're going to kind of move back and forth, and there's going to be a lot of opportunities, a lot of volatility in the year coming forward as the market kind of struggles to find its floor and a direction to move back up again. We think the market provides the best source of capital return of any investment class, and so we still think that that's the place that people want to be, even though this volatility is going to be part of the story in 2022. We've seen great opportunities to take profits and limit our exposure, and so we are going to take advantage of those. We also think that there's, in a lot of cases, there's a lot of deep value in some more traditional growth names that we've added, like Visa. They're getting into crypto and consulting work, and we think that payments is still going to be the backbone of things. And we also think that there's a lot of growth in traditional value names. We think that there's both infrastructure plays, heavy equipment manufacturing, as well as some more traditional industrials that we want to be a part of. So participation in whole market sectors like chips and healthcare and financials are not going to change in the year to come. We think that those are fantastic defensive plays that also have a good growth story behind them. But there are some names out there that have been oversold and abused, and these names are worth looking past their current price trends into how we think they're going to perform going forward. So we think blindly buying and selling names in the marketplace is doing a disservice to the investor. We think that there's a lot of weak hands out there, and so bouts of volatility are going to get a lot of people chasing this market, particularly those that have been used to double-digit returns like clockwork are going to try to recreate that. And so we think that the best way to reward investors is to or to get rewarded as an investor is to know what you own and why you own it. So we expect 2022 to be dotted with several of these tantrums. We think that there's a lot of weak hands out there who are, again, trading on news and trading on a lack of a fundamental story, and they're going to cause some major ups and downs that we're going to try to look past from time to time. When the market is priced this high, we think that those downturns are going to be a lot uglier than some of the upticks, and so we want to be prepared for that. We want to be able to embrace that. So by the end of 2022 and 2023, we might actually start seeing interest rates worthy of our participation and buying them more actively. But where they are right now, we think that looking at somewhere between 4 and 8 rate increases over the next year, we think we want to manage risk with more cash and stock allocation rather than participating in a lower volatility group. Defensive positions like financials, healthcare, and technology continue to be the backbone of what we want to own and why we want to own it. We think these are less affected by rising labor costs, and they can all three of them as a group can retain great pricing controls over their products, and so they're going to be strong in the years to come. Several of the companies that we're getting into or that we own right now, we consider them either backbones to modern business, like chips and software companies that just simply aren't going to go away but have good growth stories, or some of them are at the epicenter of sea changes that we see coming, like 5G and automation, and some changes in the transportation industry. Further still, we're investing in a huge demographic shift that's happening in the United States as baby boomers continue to get into retirement. That means seeking out good healthcare products, pharmaceuticals, and even financials as they get more and more into the financial advice space. Healthcare and technology continue to be major players for that group as well. So, we're going to cover a couple of the different places that we're adding, some changes that you're going to see in the portfolio, and as well as we're going to talk a little bit about some of the COVID, the recent news in COVID and our current approach, as well as what we see changing in 2022. Hope you enjoy. So here's a brief update on our opinion of the current COVID pandemic. And the most recent chapter in Omicron. We sent out a quick article before saying how we think that this is, part of the new world order, that this is how we are going to continue to approach Omicron and whatever Greek letters are to follow and to come. But I wanted to give you a little bit more of our take on how we are going to approach this in the marketplace. I think that Omicron is just another chapter in rolling uncertainty in the market. With each Greek letter, we will go through the same little sub-cycle of severity, what is concerning about it, it will impact the market, move into vaccination efficiency and what we've already had in place and how well our existing pillars of vaccination efficiency will helps overcome the virus, and then we will move into a response. And so as long as that continues to be the 1, 2, 3 pattern in the markets, we think that this is more of a news cycle sensitivity than anything else. And those trying to front run, viral mutations are going to find themselves in a poor position. They're going to find themselves chasing this market because these mutations aren't going to happen on any sort of release schedule. Their severity and the way that they will traffic through both the third world and the first world is going to be handled at different paces. And so with each headline having a negative impact on the market, as we had seen last week, we think that is an opportunity for us to stick to our strategy. We will continue to sell when the fundamentals tell us that the market is a little overbought, and when the market provides opportunities like a viral scale or a political upheaval or anything else that is news driven, we will continue to use that as an opportunity to add to our positions, add to places that we want to own more of. I think the biggest concern here, at least economically, is now the likelihood of a shutdown. We saw what happens when you shut down the entirety of the economy. The market goes with it, and then when you open it back up, you have supply chain issues. So I think the biggest economic uncertainty for the current state of the coronavirus is that shutdowns could impact our supply chain. So with the shutdown and reopen story kind of being the backbone of COVID as we jockey between public safety and politicians trying to keep things open, or public safety and economic vitality. I think this diminishes with each passing day as the vaccines prove that their response is, more effective than they ever were when we had no vaccines and therapeutics. That's going to raise politicians' confidence to keep production and keep supply chains open. We will move into a place where having mutations of COVID is like when we had mutations of flu. It will be kind of a non-starter, and only the people who actually traffic and understand the immunology and the response, the public health response, will take that seriously. So, as we see right now, more cautious more cautious countries are preparing for the winter wave of the virus, and less cautious countries continue to keep the pandemic rolling. This will become endemic, and it will become a seasonal, issue that we continue to dismiss on the news until there are particularly unique strains that we need to be aware of. And so it continues to move through this endemic status, between expansion and reversion. And until we get a national global response in place, which may not come for decades, I think we are just going to have to deal with this in different burns. So even here in the United States, we see that there are regional responses that are not adopted by the entire nation, and that those are, seated along both state and political lines. And as long as we are not on the same page, there is going to be no categorical response to the endemic and to the pandemic. And this will be something that we actually have to move into. For us, at least economically, the biggest problem right now is going to be its impact in third world producers. So much of the supply chain, so much of our economics is actually rooted in base components developed in Southeast Asia and other parts of the developing world, that we think as long as vaccines are not, in mass produced and distributed in those places, that we are going to continue to see an economic upheaval in the supply chain. Third world countries have a far better ability to lock down their systems to protect their people, and they also have less access to medicine. And so as long as the vaccine is still being withheld in the third world, is not being widely produced and distributed in the third world, and there are distribution problems, we're going to continue to see supply chain disruptions, because so much of our root creation, root component construction happens in Southeast Asia. So as long as, we see different iterations and different nuances, that's going to be the parts that we want to insulate ourselves from. So we, on the, trading side of all this, we want to limit our exposure to companies and to countries that see this as a long-term cycle that they're going to have to continue to deal with. So we want to reduce our exposure to things like China, and over the long term, a lot of Southeast Asia, and anything that is supply chain dependent, because we don't think they have a very good control over it. So one of the stocks we look forward to adding even more of, but we're going to begin a position for in both the growth and the market portfolios, is ASML. Now, ASML, let me tell you a little bit about the company. ASML is a large-scale manufacturer, or actually they manage both the supply chain and the construction of some of the components that go into the semiconductor industry. So if you're going to produce on a large scale semiconductors, there's a very high, especially on the high end of the semiconductor construction. If you're going to get into that business, there's a very high likelihood that ASML is your largest supplier of both the know-how, the components, the consulting, and actually the construction of the equipment that will go into building that. So, the whole lithography space is incredibly complex. It requires a lot of very intimate understanding of light mechanics, of chemistry, and how the actual wafer is going to be constructed, and then how light permeates that wafer in the right way to construct these chips. And so ASML has a decade of lab research and actual construction of the chips that you and I use today. And we think that that chips going forward is even going to be a larger part of our day-to-day lives. So the ability to simply fabricate the research and basic know-how of that the ASML has been able to kind of garner over the last 30 years of chip construction, we think at this point is insurmountable. So they will be a holding that we look forward to having a large exposure to over the next 10, 20 years, as more and more of the chip supply kind of falls on who can make those chips. So we think that there's no doubt that the recent supply shock that has hit the chip space, a lot of that happens kind of in the lower end chips, but we don't think that's going to be unique to them. So you're going to see more and more companies try to near source their supply of chips. And as we see companies like Apple and Google get into making their own versions of chips and actually having to create their own foundries and their own ways to construct those chips, more and more business is going to flow towards ASML. The dawn of 5G, we think, is going to be a huge game changer for a lot of telecommunications. Not only will new chips need to be constructed in your handhelds and other products that are tied to the Internet of Things, but also, the towers that handle 5G communications, the transfer stations, and the satellites that go into supporting that network will all have to see their chips upgraded. The fundamental story of ASML, it's been on our radar for a long time, but we've said, it's just simply too expensive. But we think that there are now both cyclical and structural tailwinds that are changing, changing demand in the semiconductor space. And the recent shortage is going to show people why they have to do more, in-house, or at least have a supply chain that is more reliable. And so ASML clients are going to expand in both the capacity, so the number of machines that they have producing chips, as well as the different types of chips. Growth for this company, just in 2021 saw a 32% increase in its revenue, the earnings per share in line with that. And so we think that this is a company that's going to see more and more phone calls. They get to actually turn away a lot of business, which puts them in the driver's seat for maintaining both their margins and price control in the space. And so we're very excited about that. There has been a recent sell-off in the stock, and so we think technically this is an opportunity for us to capture a little bit of it in our portfolios, and we will continue with every kind of troughing motion that the stock makes, continue to add more as it's prudent for the portfolio. So that's a little new company that you will notice in your portfolio. So one of the other new areas that we have added to our portfolio is a greater emphasis on trucking and transportation. We think that after all the political jockeying, the infrastructure deal has been agreed to, but we are going to see a broad amount of money and change, sophistication into the efficiencies of our ports, roadways, and rail. And major U.S. investments in this space will draw down the operating costs in that space and drive new investment into some of the equipment that they'll need to operate. Now, traditionally, if you ask me, transportation and trucking, trains has been a very unsexy space, but the purchasing of new trains, trucks, and farm equipment, planes, was largely arrested during the pandemic. Like most things that were, that were pinned to that uncertainty. And so we saw pretty poor numbers out of all of the producers, from Caterpillar, Deere, Boeing, kind of get exacerbated as a result of that. But we think that's a short-term hiccup in a trend where we see a sea change of new technology being essential and part of our modern commerce. There's new players in the logistics space. They're all looking to reduce the exposure to labor and to turn, to technology as an answer to that question. Amazon, UPS, even Hertz are looking to electrify their fleets and kind of optimize or automate some of the machines that they actually are building or are using. And so we think that that's going to be, their answer to rising costs of labor and simply an inability to put people and drivers everywhere that they want one. And so this increased demand for that last mile delivery, we think, is going to affect a couple of different players in the logistics space. And we think that a real revitalization of the equipment that they use is going to be essential to that. So we think that answering the logistics question is it's less than a decade away. That we're already seeing huge strides in automation in the heavy equipment manufacturers. We've already seen it in the farming and planes. And so we think the next knock-on effect, we're going to see that in some of the trucking and other transportation, particularly on the last mile delivery capabilities of the fleet. So as I said before, there was a lot of suppressed buying, particularly early in the pandemic. Several of the traditional buyers of farm equipment and trucking suppressed their buying during the pandemic, unsure if it was even going to be used, if transportation was going to be available to them, or if they could afford it, given the nature of the economics at the time. And so a lot of that, even bleeding over into this year, has impacted those traditional buyers. And we think that's going to dissipate in the year to come. We think that that is pent-up demand and not lost demand. So in 2022, we're going to see a lot of the upgrading and updating of those vehicles and machines, and we're going to see them bring forward some sales that were arrested in 2021 and 2020, and we're going to see them bring forward in 2022. And more so, we've seen an increase in the GDP linked to these delivery systems. For a century, our economy has been based on the consumption of goods and that supply chain, going from the producer on one end to the retailer on the other. But we think more and more so, things getting delivered to the home, that last mile is becoming a little further and a little further. And we think that that's a whole new place and in a whole new piece of our economy that's dependent on you getting your product to someone's home and not just to the store shelves. So this isn't new. This isn't a trend that has been showing itself more and more so, but the pandemic brought so much of that supply forward. And we don't think that that's a tide that's going to recede anytime soon. And those that agree with us are Amazon, UPS, and FedEx, all of whom have seen that the delivery to the home is being the new frontier and also the new issue that they're going to have to overcome. It's an incredibly costly last mile. You get low efficiency. And so for them, that is the biggest bang for their buck on some of this investment. Which drives us into the next area. We think there's huge technological innovations that have come in this landscape of machinery. They're more integrated, more automated. It's already changing the way we use a lot of big machines. And we've seen a lot of software and technology integration elements making their way even into home delivery. There have been several jokes about it, but using things like drones and automated delivery vehicles is definitely on the radar for Amazon. And we think that the result of their push into both greenification and how quickly they were able to kind of green up their fleet before and during the pandemic now seems that the next frontier for them is more automation of those green vehicles, and marrying those two means more and more equipment that they're going to have to buy to meet that business need that they've created. We think several technology shifts will force the logistics companies that are competing with Amazon to follow also, and for the world to begin, looking differently at the way we have delivery and transportation fleets and what technology kind of drives that. And so much of the manufacturers of this equipment already have the software, already have the automation, and already have the integration that's going to make them successful. It's now time for some of those companies to start buying it. And so we see a real change in the way that the fleet both looks and operates and who's out there buying it. And then a return to flying. We think part of this group is also part of transportations is also Boeing. Its Dreamliner is no longer grounded. We're going to start seeing some orders for it. This was a hugely anticipated piece of heavy equipment that was really, very sought after by the buyers of planes. And so when it had software issues and when we saw a couple of different compliance things ground that as part of the fleet, it was a huge setback for both the production and for the maintenance contracts for Boeing. And we think that a real change is going to happen in flying too. It's going to be more and more delivery-based flying, and we do think that we will get back to flying for leisure. And so as we saw all that suppressed buying for new planes, we think that's going to rebound too. There's also a new demand in the flight space and in the technology that's on those planes to be antiviral and to kind of respond to the at now present COVID pandemic. And so we think their response to incorporating those types of technologies into the new plane fleet is also going to go a long way. It's going to be part of what consumers demand when they return to the air, that the air they breathe is being filtered and it's safer. And we think that Boeing has that technology, is implementing it into the Dreamliner fleet, and we'll see purchases as a result of that. So the whole trucking and transportation space, top down, we see as being essential to the economy. It's incredibly interlinked to how our GDP in the United States is going to function. So we want to increase our exposure to that, not only because we're coming off of some poor returns in 2020 and 2021, but also because we think that a lot of the technological incorporations are really going to change what the fleet looks like in the years to come. Thank you very much for joining us on another installment of the Near Sight and Far Sight. I've been your host, Kevin Taylor. We hope that you have a renewed faith in what we're doing and a good understanding of where we think we're going to drive the portfolio going forward. As always, if you have any questions, please feel free to give me or Peter Locke a call. We'd be happy to talk to you about your portfolio and about what we're doing here at the offices of Insight. Thanks again. Have a great new year.